technical trading systems. So, as we said, if there is not one strategy or one trading system that works for every single market, if there is no holy grail, then how do we make profits? How do we become profitable over time? What we need to do is not have a fixed trading system or a fixed trading strategy. We need a strategy that's malleable, that evolves along with the markets. We need to tailor our strategy depending on the market and depending on the time frame in question. We need to find the right strategy for that particular asset at that particular time. And as we mentioned, the right strategy will be different as markets change. So if the market condition changes, a particular stock will change its behavior. So a strategy that worked previously may not work now. And this is because market structures change. Price behavior changes. There are patterns in price behavior. That is definitely the case. In fact, technical analysis is based on the idea that there are patterns in price behavior. But those patterns can change. Patterns that were common before may not be common today. And this is why our strategy needs to be consistently evolving. We need to have a technical trading system that is not static, that is dynamic. A dynamic technical trading system. And this will be the main focus of the fourth module in this course. It will be how to create this dynamic technical trading system that finds us the right strategy for the right asset at the right time. Limitations of technical analysis. Now we come to the final part of this lecture. We've spent the first part talking, following the course structure. We talked about what is technical analysis, what is the philosophy behind technical analysis, when is it useful, how does it differ from fundamental analysis, etc. Now we want to move on to something that's equally important, that is the limitations of technical analysis. Essentially, we need to understand when technical analysis will not work. Because technical analysis does have its limitations, like any form of market analysis. So we need to understand these limitations, understand when exactly it does not work, in order for us to successfully use it. Right? If we know when it doesn't work, then we can avoid the situations when it doesn't work. We can just not trade in those situations, or we can use a different form of analysis in those situations. Whatever we decide to do. The fact is that there are situations where technical analysis does not work. That is, there are limitations to technical analysis, and we need to understand what these are. Here we have the graph of a particular stock price. Now I have deliberately left out the time period, and I have deliberately not told you what stock this is. All I will tell you that it is a stock of a large multinational corporation. Maybe as the more I talk about it, if you can guess what the stock is. So what we can see from this chart here is that the stock price steadily grew over time. We had very moderate growth early in this graph. We had a very large upward spike in the middle, and then our moderate growth continued. We had some accelerated growth later on, before a brief dip and rise after that. Now what can we make of this graph? Well, what we can say is that there is a fairly clear uptrend to this graph. This looks like a pretty solid stock that has consistently performed well. That must be a company that's grown, and as we said, this is a large multinational company, so clearly its success has been successful. Now what would the technical analysis tell us in this situation? Chances are we would see this as a nice uptrending stock, and the technical analysis would tell us that we should buy this stock. It's been doing well. It's a good company. It's been uptrending. It's likely to continue doing the same going forward. Now look at this graph. This graph is actually the same stock as in the previous graph. And what we can see here is that following that large uptrending period, the stock started to trend downwards again. In fact, it's gone all the way down to very, very close to zero. So it's very clear that had we followed our strategy of this being in an uptrend, so we should buy, the stock has done the exact opposite of what we thought. It has actually collapsed all the way down to zero, or very close to zero at least. Now the reason I have shown you this graph is that this is a fairly clear example of where technical analysis would not work. If we had looked at just that first graph, we looked at the stock price, say, over a 12-year period, which is a long period, 94 to 2006, any analysis we would have done, be it statistical, be it graphical, would tell us that this should continue rising, when actually the exact opposite occurred. And why is this? Well, this is an example of a changing market situation, right? The financial crisis occurred, so market conditions have changed, and dramatically they changed. So in this situation, it's fairly clear that technical analysis would not work. So this is just to give you some perspective that we do need to keep market conditions in mind. We do need to keep fundamentals in mind at all times. Predicting the news. One of the biggest weaknesses of technical analysis is its inability to predict the news. Now we know that whenever news is released, it has an impact on the markets. Markets move when news comes out. And this news is of course unpredictable. We can't predict what the news will be. And unfortunately, neither can technical analysis. We really generally cannot use technical analysis to predict the news. Let's go back to our Lehman Brothers example. Lehman Brothers' stock price collapsed due to the news of its bankruptcy. Now, we would not be able to learn about its bankruptcy using technical analysis. And that's because the bankruptcy is news about the company. So if we want to be successful in using technical analysis, we need to understand exactly when it does not work. And predicting the news is one of those things, examples, and one of the situations where it does not work. Now let's go into a little bit more detail about why predicting the news is not done by technical analysis. Now in general, whenever a news event comes out, the price is usually driven by the fundamentals. Okay? So let's say, for example, we get news that Lehman Brothers is going to go bankrupt. Now that is an event, or that is a piece of news that affects the underlying fundamental value of the company. Right? News of bankruptcy means that the company will be worthless. And so hence the stock price falls down to zero. And this is an example of the price being driven purely by fundamental behavior. Right? The fundamental behavior here is that the fundamental value is changing, and the price is being driven by that. So when the price is being driven by fundamentals, in these situations, technical analysis is not as useful. Right? If you remember earlier, we talked about technical analysis being useful to fill the gaps where fundamental analysis does not work. The fundamental analysis has trouble in short to medium term time frames. It works better in the longer term. But fundamental analysis also works when it comes to the news. Now, obviously, we can't predict the news, but what we do know is that the news is a fundamental event, and this fundamental event is what drives the price when the news is released. Now, there are some instances where we will know beforehand when news is coming out, right? So let's say, for example, GDP growth rate figures are going to be released. Now, at regular intervals, the statistical organizations in the government release figures like GDP growth. And they will usually have a set time and date when they will release this. So in this case, we may be aware that significant news is due to come out. Now, after GDP growth is released, the markets will react in one of two ways. Let's say we're talking about the stock market as a whole. If GDP growth is better than expected, the stock market will rise. If GDP growth is worse than expected, the stock market will fall. And we can't predict which way this will go because we don't know what the news will be. And as a result, these are instances where we should not trade. These are simply instances where technical analysis will not help us, because we know that the stock price following the news event will be driven by that news event, so there is no point trying to use technical analysis to predict where the stock will go. On the other hand, if we want to actually predict what the news will be, let's say we wanted to predict whether the news will be higher than expected GDP growth, then we can use fundamental analysis. Now, this is actually what fundamental analysis aims to do. It actually aims to predict the news. Because if you think about when we're valuing a stock, with fundamental analysis, we're trying to forecast a company's earnings before it is released. And then when the earnings news comes out, we're either going to be right or wrong, and we'll make or lose money depending on what we thought would happen relative to what actually did occur. Limitations. Now let's just conclude quickly with some more detail about the limitations of technical analysis. In general, technical analysis is less useful whenever fundamentals play a greater role. And in contrast, whenever fundamentals play a smaller role, technical analysis is more useful. And now we've discussed the two instances where fundamental analysis is not useful and technical analysis is more useful. So one is when we talk about time frames. When we're talking about long-term time frames, fundamental analysis is most useful and technical analysis is less useful. Now when we're talking about short to medium-term time frames, technical analysis is more useful relative to fundamental analysis, given that the market tends to deviate from its fundamental value in the short to medium term. And the other instance where fundamental analysis is more useful, and this is in the short term too, is when important news is about to be released. So right before important news is about to be released, technical analysis is less useful, and fundamental analysis is more useful. But that doesn't mean we can't use technical analysis to trade. For example, often if there is a significant news event and the market moves sharply in one direction, there will often be a reversal that occurs after that. And this is a technical phenomenon. So we can actually use technical analysis to take a position after news has been released, because we feel that the market often temporarily overextends itself. So just because there are limitations, it certainly does not mean that technical analysis is not useful. It is very useful, and in many instances, it can be a huge aid to making money for us and making money on our trades. Conclusion. This brings us to the conclusion of our first lecture. We hope you have found it useful and a good introduction. And let's just recap exactly what we have gone through in this lecture. We started by talking about the course overview, the structure, and the aims of the course. And what we have learned is that, what we know is that the purpose of this course is to learn how to use technical analysis to predict movements in the financial markets. We are going to specifically learn how to build a trading system using technical analysis and how to make it work for us. We'll learn how to find the right indicator for the right asset at the right time. Other important concepts we've also learned is that technical analysis is not a holy grail. There is no magic indicator or magic strategy that works every time. But if we learn to apply concepts in the correct way, we can still be profitable over the long term. We also learned that the two main approaches to technical analysis are charting and indicators, or statistical analysis. We talked a bit about what those are, and we talked about the advantages and disadvantages of both. And we talked about how we will learn each of those approaches in significant detail in the next modules 2 and 3. Finally, we concluded the lecture by talking about some of the limitations of technical analysis. And what we learned is that one of the main limitations of technical analysis is its inability to predict the news. And whether this be a company's earnings, GDP figures, or bankruptcy that caused a financial crisis, technical analysis is limited in its ability to predict the news. And this is very important. So this brings us to the end of lecture 1.